So capital gains tax, we'll start off with something relatively straightforward, and then we'll take it from there. Cool. Can you all see my screen? Participants. Cool. Right. So these are here. It says chattels here. And that's just to help you. In the exam, it will not tell you it is a chattel. This is a question you do not have access to. So don't try and find it in your notes. It's an extra question. I will email it out with the recording tomorrow. So you'll have the recording and you'll have the questions. You have to go yourself. Cool. So we are looking at a painting, diamond ring, antique vase, and a necklace. Now, it does tell you our chattels. In the exam, it will not tell you that it's a chattel. You need to remember that, and you need to apply the chattel rules. So you need to remember you've got that 2x2 matrix. Make sure you can remember that 2x2 matrix because it will almost certainly in the exam. Cool. So let's work through these one by one. And now the key things are obviously the proceeds and the cost. So the first one, we've got proceeds of £5,900 and a cost of £300. What is our gain and loss on this? Anyone feel brave? That's right. The few, because if we've got our 2x2 matrix, if you've got £6,000 here, £6,000 here, and this is cost, and this is proceeds. If they are both the cost and the below, both are below £6,000, it is exempt. So we are not going to have any gain there. And the reason being, do HMRC really want people reporting that they bought something on Facebook Marketplace for 10 quid and then sold it 6 months later for 20 quid? Not really, no one cares. So it just stops people having to report minor things that no one really cares about, and no one wants to be doing self-assessment forms for something that's neither here nor there. Next one. The diamond ring. So we've got proceeds of 14,700 and cost of 5,100. Now, what's the issue here? We've got proceeds above 6,000, but the cost is below. That's right. Now, I was asked this the other week. Why is it the 5/3 rule? I have no idea why it's the 5/3 rule. It just is, and you need to know it. So what this means is we have a gain where the proceeds are above and the cost are below, and we might be able to calculate it normally, or we might apply a restriction, but we need to check. So to calculate it normally, we'll do a little working. You can never do too many workings in tax. So the working one, we've got the gain normally. So you've got proceeds of £14,700, cost of 5,100, gives us a gain of minus 510 of £9,600. So that's the gain normally. But now we're going to calculate the restriction. We might need to do this. So what we'll do is take the 14,700 proceeds, take off £6,000, gives us 14,700 minus 6, gives us 8,700, which if we multiply it by 5 and then divide by 3, gives us a figure of 14,500. So the restriction is actually greater than the gain. So we choose the lower. So we're going to choose that figure there, £9,600. So we're going to ignore the restriction because it's greater. Cool. Next one, we have proceeds below 6,000 and cost above 6,000. what are we going to do here? That's right. So what we're going to do here, with this, we're going to deem the proceeds to be £6,000. So for the vase, we've got proceeds, £6,000 less the cost of 7,900, giving us a loss of 1,900. Now, it doesn't matter what the proceeds actually were, as long as the proceeds were below 6,000 and the cost was above, the proceeds will be deemed to be £6,000, giving a loss of £1,900. Cool. Last one. This is the case where we have the proceeds above £6,000 and the cost above £6,000. That's just going to be a normal gains calculation. There's no messing around with deemed proceeds or 5/3 rules. That's just proceeds, 6,900 less cost, 6,100, gives us an £800 loss. Cool. Gain it is. £800. So for bonus points, what do we have to do with the loss of £1,900? That's right, and this is nicely going to segue into my next question. We have to offset that current year loss against current year gains. And we're going to look at that next. Cool. Could it be 5/3 because take time divided by 2? But Tanisha, it could well be. I have no idea. Is the honest? No, I've no idea. I've never understood, or no one's ever told me why it's 5/3. It's always been 5/3. When I did AAT years ago, it was 5/3. And in those days, the VAT rate was a different rate. So it's been 17.5%, 15%, it's now 20%. And it's always been 5/3. So I still don't know why it's 5/3, but probably related to VAT because it's not changed alongside VAT. But very good thought, actually. I like that thinking. Cool. Right. I'm going to segue into this one. So this is from your AAT mock, AAT mock 1, actually. And this is what I want to look at here in terms of losses. So remember, losses, and this is going to be really examinable. Current year losses have to be offset against current year gains. Brought forward losses don't. Now, I thought, because I was quickly looking for a question, I was going to thought, oh, they want to do the usual one where we restrict the losses brought forward. And they didn't actually do it in this question. This is slightly different to most capital gains loss questions, but the principles are still the same. So in the first one, we have a gain of £7,250. And we also have a loss of £20,300. Now we have to offset that loss against the gain. We have to. There's nothing we can do about that. We can't do any funny or clever manipulation of losses. So that is going to give us an overall loss for the year, which was on, of 7,250 minus 200 gives a figure of £13,050. Is everyone okay where that has come from? Cool. Right. So that's the what we're going to call it, net gain. Not taxable gain, net gain. So net gain is where we've added up all our gains for the year and all our losses for the year, and that is before the deduction of the annual exempt amount, because that would be taxable gains. So this is our net gain. So in the second year, we've got a gain of £25,610 and a loss of £15,300, gives us a net gain of £10,310. Yeah, it would be a loss. But yeah, it is what the figure I'm getting at is prior to the deduction of any annual exempt amount. Now, in this 1920 year, we lose the annual exempt amount. There's nothing we can do about that because we've got a loss and we have to offset that loss against our gains. That annual exempt amount of £12,000 is just lost. You can't carry it forward like we did last week for 1 year with inheritance tax annual exempt amounts. It's just lost. So obviously you don't want to lose annual exempt amounts because it's a tax-free amount. You want to use it as much as you can, which leads into the 2020-21 tax year. So we've got net gains now of £10,310. So we've got a choice of we can either use our losses or we don't. What do we want to do here? Now, what we want to do here is actually not use our losses. Yeah, Carl is right. We want to use the annual exempt amount. So the annual exempt amount is greater than the gain for that year. So we don't want to use any losses. We just want to use the annual exempt amount. So the 12,300 more than covers our gain of 10,310. So 12,300 minus 10,310 means there's £1,990 of our AE which we've lost. We can't use it because we don't have enough gains, which is, it's annoying, but there's nothing you can do about it. But still, that is far better than using our losses and wasting all the annual exempt amount, because the losses will carry forward until we actually can use them or even want to use them. Whereas the annual exempt amount, we want to use as much as that as we possibly can, which means £13,050 of losses are going to be carried forward into future years. Now, typically, so I'm going to amend this question here. Typically, the questions that I normally see is, for example, this figure here, the net gains would be, let's make it easy for myself, £16,300. So we've got net gains of £16,300. And the question will say, how much of your loss are you going to carry forward? So when you've got losses brought forward, you can choose to use them, and you can also choose how much you use them. So if we just use £4,000 of losses brought forward, that leaves taxable, no, it doesn't, it leaves net gains of 12,300. Sorry, the 19 is, this is 12,300 of the AE minus the 10,310 gain for the year. $13,050, Amy, is that gain less that loss. $25,610. No, Eve, we've got the loss of 15,300. That has to be offset against that gain before we can touch anything with AE. So that loss has to be offset against the gain to give us net gains of 10,310, and then we can start looking at the AE. Cool. So going back to my alternative scenario, this is not the question I am making up as we go along. You have gains for the year of £16,300. We've got losses brought forward of 13,050. So that's our loss memo. Now we want to use £4,000 of losses brought forward. That will leave us with net gains of 12,300. We can then take off the AE of 12,300, which by sheer magic, luck, coincidence, whatever you want to call it, is really. And then obviously we'll update our loss memo. So if we use 4,000, which means we've got, I'll do it in my head, £9,050 of losses carried forward. So what we can do is just use enough losses to leave enough gains that they'll be covered by our AE. So that's the other type of question you can possibly get. This one here, where really, I would normally suggest the more likely to test it this way, because then we are using the loss brought forward rule versus current year losses. Yeah, Walter, £12,500 is the personal allowance for income tax. The annual exempt amount for capital gains tax is £12,300. AEs, you can't go back. AEs, you just have them or you don't. It's not like losses or anything like that when you are talking about corporation tax, federal and business tax. AEs, it's just use it or lose it. Cool. So that's just one thing I wanted to look at is losses, because that's really testable. The next thing I want to look at is quite a long, drawn-out question. There's lots going on here, and I don't think you would get a question like this. There's an awful lot going on, if I'm being honest, but parts of this could come up, so we're going to go through it all. Good question. Sarah, you can't add them both together because loss here has all been used against the current year gains. So that one's gone. Really. So that's why you can't. You can only use the losses from the previous year because you haven't used them as yet. Cool. Next one. Can you use 3 columns? I can try. You've got way more in this question than you would actually get given in the question. So I am slightly disadvantaged in that you could probably ignore some of this, and that would be more typical of an exam question. We'll give it a go. Right, let's work through here. So James sold half his field for £300,000. The remaining half is valued at £200,000. And the field originally cost £60,000. So he only sold half of it. Are we going to use £30,000 in our gains calculation? No, because he's obviously sold the better half of it. The bit that's next to a housing estate that's clearly going to get planning permission on it or something like that, and he's left with the boggy half, which isn't worth half as much. So we need to do a part disposal calculation. So where's my mouse gone? So I'm going to zoom in, make it a bit more readable. So apologies if we're a bit scrolling up and down, maybe not that far. So you've got the field, and that has, yes, as Eve and Bradley both said, you need to use this formula, which is not given in the reference material. You have to know this. So you've got proceeds of, so he sold it for £300,000, so we know the proceeds of that. 1, 2, 3, and then we've got the cost. Now the cost I'm going to take for a working. So working 1 is going to be the original cost of £60,000 multiplied by the market value of the bit that was sold, which we know was £300,000, over the market value of the bit that sold, 300,000, plus the market value of the bit that was remaining, £200,000. So that's going to be £500,000. So 300 divided by 500 gives us 0.6 times the original cost of £60,000, gives us a cost of £36,000. Yes, and I did remember to record, unlike the other week. Cool. So And the thing that I often see that happens in a question like this, students get all excited. I remember the formula, and then they give me the cost, which is great, but that's not what we're looking for. We are looking for the gain. So the gain is going to be, probably do it in my head, £264,000. Cool. Right. Tick that one off. What have we got? A greyhound sold for £6,000. No cost. What are we going to do with the greyhound? Yes. Well, actually, we are going to do something with the greyhound. We are going to tell the examiner that we know it is a exempt because it is a wasting chattel. We don't want the examiner to think that we've just missed it. We want him to know that. Cool. Tick that. Right. Sold a painting to his mother for £30,000. It originally cost him £20,000. It was valued at £25,000 and was previously sold a desk to his father with a loss of £3,000. Eve, no, I think you can get away without saying wasting chattel. You don't need to say why it's exempt, but I'd definitely suggest you say it's exempt. Definitely. So there's quite a bit going on with this painting. He actually got £30,000 for it. It cost him 20. It was valued at 25, and we've got a connected loss. So anyone be daring and tell me what figure am I going to use? Bear in mind, he actually sold it for more than the market value. I thought I was going to catch a few people out. Now, typically, market value is normally greater than the proceeds because you're underselling it to try and not pay as much capital gains tax. But it doesn't matter whether the proceeds are greater or less than what it was. We will always use the market value if it's a connected person. And remember, connected people are parents, grandparents, children, grandchildren, sisters, brothers, sister-in-laws, brothers-in-laws, business partners, but not your spouse or civil partner. Yeah, he could be fleecing his mother, or, which is not the case here, or he could be trying to get a gain, use his annual exempt amount, so he doesn't pay any tax, then his mother goes and sells it on, and she's got a higher base cost. But that would be irrelevant because that would be lying and cheating, and we would use the market value anyway. Or he could just not like his mother. It's another way of doing it. Just lied to her, for all I know. Anyway, it doesn't really matter. Let's go and get it in there. So we've got, what is it? It's a painting, isn't it? Oh, pen working. So we've got proceeds. And we're going to put market value, which was 25,000, wasn't it? 2, 3. Then we've got the cost, which I can remember, even I can remember this, is £20,000. And then we've got losses as well. Now, the losses are to a connected person, but it's not the very same connected person. So it doesn't matter about that. We can't use those losses until, well, he can't use those losses until he makes a gain on an asset disposal to his father. So we're just going to ignore all that. So that gives us a gain of £5,000. Take that off, take that off. What else we got? Tick that off. Right. Next one. Sold at auction an antique chair for £7,500. Originally cost him £4,000. What's the issue with this one? Chair. Yes, it is that horrible 5/3 calculation. So we will, how are we going to do this? Proceeds here of, what do we sell it for? £7,500. £7,500, £7,500, normal, restriction. there's nothing else. There's no cost and disposals, thankfully. Cost of £4,000 gives us, what's that, £3,500. But then we're going to take off £6,000, gives us 1,500 times by 5 over 3, gives us figure of 2,500. So that's the lowest. That's what we're going to use. I'm tempted not overly worry about the loss to his father. I mean, you could just, ideally, if you're being really pedantic, you could say irrelevant because it's not the same connected person. I think we do have model solutions, but yeah. Anyway, so we've got £2,500 for the chair. Now, this is where we run out of space. A clock, which was proceeds deemed, would be £6,000, and we allowed cost of £8,000, meaning a loss of £2,000. Cool. So we've been through all our transactions. So we've got losses brought forward, we've got taxable income, and we've got, well, we've got to calculate capital gains tax, which is what most questions are about. So what we need to do is add all these up. So we need to get our net gains for the year. Now, assume I'm just carrying on down because I've run out of space, because we have loads and loads of transactions and you won't get this many in a question. But net gains, assume we just got more rows on our grid. So net gains of, let's add them all up, £264,000 plus £5,000 plus 2,500. Remember, we've used the restriction, and a loss minus £2,000 gives us a figure of £269,500. So then, now we haven't got enough losses to do anything clever like leave the annual exempt amount, unfortunately. We may as well use them, given the fact that he's got some big losses. He's going to be paying the higher rate. We may as well use them now. Now, Anna, the father's loss, we can't do anything with. We can't use that loss against anything else. Now, if we'd made a disposal this year to the father, we could have used it. But none of these transactions, as far as we were or were told, was to the father. Therefore, that loss is just parked. So we've got capital loss of 2,400. So loss brought forward 2,400. Take that off. Gives a figure of £267,100. Now, never ever forget the next step, which is the AE. Very easily done. So the AE of £12,300 needs to come off. Gives a figure of £254,800. So that's our taxable gains. Yeah, that very good question, Jessica. Yes, it is. It is loss brought forward, then AE, because if you were trying to be clever and use the losses brought forward, you need to take them off to leave enough gain for the AE. You don't take the AE off first and then your losses brought forward, because you want to be able to restrict your losses if you could. We haven't got enough here, but if you wanted to leave enough for your AE, but we haven't got enough here. So the next thing is basically we just need to tax it. Now we've got other taxable income of £22,500. So can I remember what our basic rate band is? That's right. Adine is the first one to answer. So 37,500 minus what was it? 22,500 means we have £15,000 of losses, which we taxed at the lower rate of 10%, giving even I could do that, £1,500, and the rest, so £254,800 minus 15,000 is £239,800 at 20% times 0.2 gives a figure of a whopping £47,960,000. But then he shouldn't have sold that field. Plus 1,500 gives a figure of £49,460. Everyone follow me up to there. The 22,500 is his other taxable income. So that's things like his employment, self-employment, savings, dividends, anything that's used up the basic rate band. We'll do that. Now, so we've taxed some at 10% and we've taxed some at 20%. If there had been residential property in here, what would the rates have been for the residential property? That's right, Patty's right. So if it had been residential property, it would have been taxed at a rate of 18% and 28%. That is not given in the reference material, by the way. Yes, and the question is why I increased it further. It's that figure, which was the £15,000 at 10%, plus the amount that had been taxed at 20%, giving overall capital gains tax payable, CGT, of £49,460. Yeah, Ellie, a very good question. Obviously, you won't be writing them with this electronic pen. That's not the easiest thing to write with, I'll be honest. Basically, you need to make it easy to follow to marking, because markers for this get paid per paper. Now, I've been there where you get paid a set amount per paper. Now, as a marker, well, as a tutor, you don't like to see blank answers. But from a marker, you think, well, that's the easiest £5 I'll ever get. But obviously, you're not going to get, if someone's difficult to follow through, you're going to try and do it. But if it's just a mess, you're going to say, no, I just can't follow this, and you're not going to get the marks. If it's nice and straightforward and you can see where your figures have come from, it's a lot easier for the marker to run down and go tick, tick, tick. And the other thing is, remember, the own figure rule applies. So if your tax figure is wrong, say this figure all the way down here is wrong, obviously you've lost some marks somewhere. But if they can follow backwards from what you've previously done, you'll still pick up loads and loads of marks. And if you show your workings, for example, like this is an example here, we've done a part X, part disposal calculation. Now, if they can see you've used the correct formula and you've just made a calculation error, you'll get partial credit. If you don't show your workings, and you're working on a bit of paper, and you just pull out a cost figure out of thin air, they're just going to, and it's wrong, they're going to go, what on earth is that? I don't know that you used the part disposal calculation. I'm just not going to give you the marks. So it needs to be nice and clear and easy to follow. And that follows for inheritance tax computations, income tax computations, share pools, always remember that another human being has to mark it. Really? Cool. That's it for capital gains tax. Capital gains tax is, it's not the hardest one in personal tax, but it is one of those that's definitely going to be there, and it's definitely worth a couple of tasks. Cool. Any questions on that? Cool. So in terms of revision classes, we're going to do income tax computations next week, because they, again, are going to be in your exam, and it's all about exam technique and following it through that. Diana, difference between annual value and rateable value. So annual value, basically they are the same thing, but they are based on what would be the rent that the company would pay if they, well, it depends. If the business rent the property, the benefit in kind or the annual value is what they pay. Now, if they don't, the annual value is based on what it would be on commercial rates, but it will give you that in exam. So don't worry about that. Yeah, you've got to calculate the gains on a residential property separately because you would, because they've got different rates. You can't just lump it all together. Yeah, so remember, it is residential property only. So if it's like a factory or land, doesn't matter. It is 10 and 20%. It's only residential property. And generally that sort of thing ties up with a PPR question more than anything else. So it's just like one property that's been disposed of. No, it's typically it's more getting at a PPR type question. The lovely months that we all love. The basic savings rate. Now, Anna's asked a very good question. Now, prior to this year, AAT used to assess the savings starting rate band. So the first £5,000 of your income, if it wasn't used up by non-savings, could be, if it was savings, could be taxed at 0%. And there's a few questions kicking around from from last year. It's still a thing in the real world. So, but AAT have pulled it very quietly at the end of last year. So you don't need to know that, the basic savings rate. All you need to know is that there's a savings allowance of £1,000 and savings allowance of £500, depending if you're a higher rate taxpayer. But yeah, AAT removed that for whatever reason. I don't know. It was in last year's exam without telling anyone. So it's not like it's disappeared from the real world. It is a thing, but AAT have just pulled it for whatever reason. Yeah, so all you need to know is like Justin says, is either 1,500 or 0% savings allowance. And all questions you level C will be written where the first £5,000 of your basic rate band is full of non-savings income. So you can't get into the savings rate band. But yeah, it's not disappeared from the world. AAT just stopped examining it. Just think, no, if your income is over £125,000, your personal allowance will be, if your income's over 150,000 taxable income, that is, you'll be an additional rate taxpayer. Therefore, your savings allowance will be zero. And also at that rate, your personal allowance will be zero as well. Cool. Right. We've got a couple more weeks of this. I'm going to do personal tax. I am going to do personal tax, but it's going to be specifically income tax next week. And then I'm going to put open to requests after that, if I'm being honest. Benefit in kind might look at chapter 3, actually, benefit in kind, because people do struggle with that. So not benefit kind on the car, because that's really easy. You should expect that, but the other benefits in kind. Yes. Next week will be all about a tax comp using the awful 3 columns. Pay as you earn. Pay as you earn comes up so very slightly in income tax. It's basically, in a tax computation, someone's paid pay as you earn as £5,000, say. You got to calculate their tax liability, take off the PAYE, and that leaves them with their tax payable. You can have a look at a written task. There's not much say about written tasks because remember, you get charged £49 by AAT for each exam, and all exams are the same. And remember, AAT are paying markers to mark your share pool, to mark your income tax computation, to mark your inheritance tax computation. So it doesn't leave loads of money left for written questions. So written questions, typically they're task 1, and it's things looking like money laundering, because that's really, really important when you're a tax practitioner, or the difference between tax avoidance and tax evasion, and maybe something to do with pensions, occupational versus private pensions. But that's about it. Cool. Cool. No, we did inheritance tax last week. If anyone hasn't got it, email me, nickcraggs@fi.co.uk, and I'll send you out the recording to last week's thing. PPR. Don't ask me to do PPR. I hate PPR. So I always get the months wrong. Chapter off the top of my head, occupation versus private pension. I think it is chapter 6 in our books, where we look at extending the basic rate band. I might be wrong. Yes, you have to learn the rules for deemed residents. Unfortunately, they're not in the reference material. I remember, other than the last period, where it's just as long as you lived in at some point, all the other rules have to be preceded and followed at some point by actual occupation. And the only other thing is, remember, the 36 months for whatever reason is for the lifetime of the property, not for per period. So if you go away for 2 years traveling, that's used 24 months. If you come back and then go away traveling again, you can only have up to 12 months for any reason with that. The trick, Jessica, to PPR questions is count on your fingers. I cannot stress that enough. Bit of sore subject. No, for whatever reason, the person in marketing struggles to get it onto YouTube, but I've got it. So if you email me, I can get it. Bethan, what was the last point that I just mentioned? It's been a long day. Yeah, don't talk in your exam. But remember, 31st of January to 31st of December is not the same period as the 1st of January to the 31st of December. 36, yes. So you get 36 months where you are deemed to be in your property if you're out doing something other than work. And as long as it's preceded and followed at some point by actual occupation, you get 36 months. But that is for the lifetime of the property. So say, for example, you lived in your house and you went traveling, you went off to India to find yourself or something, go meditate. You weren't away for work. So say you went off to India for 2 years. That would take up 24 months of deemed residence for any other reason. And then you came back and you lived in your house for another year. Then you decided you need to go back to India to go meditate for another 2 years. Now you've already used up 24 months. So provided that second period in India was followed by actual occupation, you could only have up to 12 months for whatever reason, because you've already used 2 years already. It's for the lifetime of the property, not go away for 36 months, come home, go away for 36 months, come home kind of thing. Cool. Brilliant. Like I say, if anyone's got an exam in the next couple of days or next week, I don't see you, good luck. If not, I will hopefully see you all on this time next week, and we will do income tax, lots of income tax computations.